Welcome to Remarkable Retail Podcast, Season 4, Episode 15, the Earth Day episode. I'm Michael LeBlanc.
And I'm Steve Dennis.
Well, Steve, you and the listeners might hear a bit of background buzzing going on. I'm live. Yeah, I'm live in Montreal at a trade show called Cial, which is North America's biggest food innovation show. I'm here with Dr. Sylvain Charlebois, and we've got a podcasting studio for our great podcast food professor and meeting lots of people. So that's a bit of the background noise, and it's great to be out and amongst the people.
Man, you're so fancy.
Yeah. Well, let me tell you, just a moment on the show. It's about 20,000 people, draws countries from around the world to come showcase their innovations. I'm looking at the Brazil booth and the Italy booth. The USA's got a huge section here that they parcel out to different entrepreneurs. So, lots of food innovation happening. So for all the listeners out there, you're going to see some pretty amazing things. It's been a quiet couple of years. A lot of these brands really got punished when food service declined, like they didn't pick it up in grocery, just by the nature of their business. So a lot of these folks are telling us stories about bouncing back and lots of excitement.
Sounds like fun. You got some free samples you can ship me, or?
I got a boatload of free samples, actually, because that's what show is all about. So, everything from Camilla oil to barbecue sauce, all kinds of great stuff. So, if you're here at the show, you don't need to go buy lunch. That's for sure. You can snack your way across thousands of booths and everything you could imagine is here. But anyway, we were talking about Earth Day. Let's talk about bringing something else back down to earth. You've been on social media talking about or chitting and chatting around stores, and I think some of the narrative, and this is not new-ish, has been that you're a store defender, or you're the store advocate. What's going on here?
Yeah, this has been going on for a while, where somehow people think that I'm a big fan of stores, or I feel the need to defend stores. And I'm really not pro stores. I'm really anti bullshit because I don't care one way or another. I'm actually probably a much more likely to shop online than the average person. So I love e-commerce. I love stores sometimes as well. But the narrative that e-commerce is eating the world and that brick and mortar is doomed just isn't true. And so this episode really kind of gets into that in a little bit more detail, particularly in light of some data that came out and a piece I wrote for Forbes. And so, yeah, it's more about defying the nonsense that is out there and hopefully helping people to see through some perhaps false narratives or fallacies to hopefully make the right kind of decisions.
So as listeners probably figured out, it's a solo episode. We'll be chitting and chatting about that a bit later. But let's jump into the news. So I was seeing Canadian company based in Vancouver, Lululemon, in the news with a couple of big announcements, right? So talk about what your impression was. They talked about growing stores and I think something about a membership program.
Well, first of all, Lululemon, I think, is one of the more remarkable retailers that have been around for a while. They've grown enormously over the last few years, partially because they've got a great business model. They've executed it amazingly well. They also clearly benefited from some of the athleisure COVID trends. But they just announced this, earlier this week, that they've got a 5-year plan to double their revenue over the next 5 years. And they're going to do that through new stores, continuing to open new stores, particularly internationally, product expansion, talked about the footwear push, but they're also really going into more aggressively the men's business and some other product expansions. But yeah, the interesting thing, I think, was this membership program, a 2-tiered membership program that they shared a little bit about. And I think this is a great example of things we've talked about before, about kind of thinking about, like reconfiguring your business more as a platform, thinking about all the different ways, all the different revenue streams that you can leverage to become more important to customers. And I think this is pretty interesting, continues some trends we're seeing with other companies. My favorite thing that Calvin McDonald said in the news about, kind of finding more ways to engage with customers was, the more our customers sweat, the more they spend. And so it's getting, it's not share of wallet, I guess it's share of sweat or something.
I'm not sure how that's going to build his resell business, but Well, sticking, I guess, with the store theme, which seems to be a kind of a broader theme for the episode, Uniqlo wants to open, 400 to 500 new stores worldwide each year. Am I reading that right? Each year?
It's, I guess this isn't so much about Uniqlo other than that is an enormous number of stores. But, we just keep
on top of an enormous number of stores, right? It's not like they only have a few stores.
Right. They're already a huge player. They've been around for quite a while. So this isn't, Warby Parker starting a new store strategy. I think it's just so interesting and does tie to what we're going to talk about in the episode, that as much as e-commerce continues to grow, we still see just a tremendous amount of investment in brick and mortar, whether we're talking about Uniqlo, whether we're talking about Lululemon, whether we're talking about Ulta, you name it. There's just so many companies that have a powerful business model, that have, generally speaking, a really good digital presence, that are seeing the importance of stores. So not just Uniqlo, though that's a pretty staggering number, but just the kind of this continued march of, turns out stores aren't dead.
Let's talk about, there is also some news on the other side of the positive equation from Gap. The Old Navy CEO of Old Navy is leaving. So what do you think? What's going on with Gap? Any thoughts on that? I mean, you would think that a value-based retailer with apparel bouncing back after not a lot of demand would be okay, but they seem to be struggling. Yeah.
Yeah, I think that's a good take. I mean, right. On the one hand, with the push towards value, with apparel bouncing back, it seems like they've got some good tailwinds. I think, though, this gets to the point that even if you've got a lot of factors working to your benefit, you still have to have a remarkable value proposition. And I think the challenge, Gap's got some issues of perhaps being over-distributed and not having the right product trend. And
they've been a company, I remember, when I was at Levi's, Gap was it, man. Everybody was, Gap had momentum, and then they lost it. Then they got it back. Like, they've been ebbing and flowing for literally decades, yeah?
Yeah, there's definitely been this, hitting the trend. I think what's been challenging for the Gap brands more broadly, whether we're talking about Old Navy or Banana Republic or the flagship brand, is there's just so much competition,
Yeah.
I mean, back in the day, they had kind of defined, first with the Gap and then subsequently with Banana and Old Navy, they had kind of defined a new subsegment and moved very aggressively to open a lot of stores. And, maybe they both overshot the runway with the number of stores as well as didn't execute well. But I think, where do some of these brands really live in a world where you've got so much choice, both in physical stores as well as online? So I think, they're just kind of a mediocre brand, and it's catching up to them, even if some of the trends are on their side. Our
friend Simeon Siegel was in the news with some clever thoughts around DNVBs. You want to touch on that, or DTC? You want to touch on that for a second?
Yeah, just briefly, and I think we're going to continue to follow this story, maybe do another deep dive further down the road. But we're seeing a lot of evolution of the digitally native vertical brands as they are really struggling to be profitable. The particular thing that Simeon was talking about was what he called, and I think he coined this, the DTCing of DTC. In other words, DTC, as folks will likely know. Simeon's, yeah, he's good at coining phrases. But the obviously the original idea of direct to consumer is to go direct to consumer, to skip the wholesale part of it. And the digitally native brands were a different form of traditional DTC, like Land's End or Williams Sonoma or whatever. But what's been happening is more and more brands are starting to explore wholesale partnerships. This isn't entirely new. A number of these brands have been at Nordstrom, have been at Target, and some other places. And I think the benefits for the host department store or whoever, discount store, having those brands, gives them an element of differentiation, which can be important to their model. And for the DNVBs, it gives them more distribution at potentially a lower cost because they get to leverage the marketing of the host brand, so to speak. I think what is accelerating it is this continuing narrative, which we've touched on a bunch of times, is that many of these brands are really struggling to get to profitability. And the possible advantages of wholesale are being explored more aggressively. So watch this space. The other thing that was in the news in this regard was, and again, this is something we started to see a few years ago, but it's really picking up pace, but kind of for the same reasons, is that many of these brands, which had leaned so heavily on Facebook advertising in particular, but other targeted direct digital advertising, are moving away from that because it's become so expensive. And as we got into in a prior episode with Dan McCarthy, the lifetime value dynamics of that have gotten really, really challenging. But what they're moving away to is, are you ready for this? Print catalogs sent through the mail. Everything old is new again in retail. That's awesome. It seems.
We'll be getting the yellow pages at my door soon if this keeps up.
I mean, nothing.
I can never find a plumber. Anymore. I can never find a good plumber on Google. If there was only something I'm dropped on my doorstep each spring where I could find a good plumber, it would solve all my problems. All right, listen, good discussion, good introduction, and why don't we just get now into this broader discussion about stores and the role of stores and strategy, and I think, as you said in the beginning, really as a guide to help the listeners and executives think through strategy, right? Really a very strategic discussion about beyond the headlines, so to speak. So let's get to that now.
As I shared a little bit on social media, I don't really care one way or another whether e-commerce grows more than stores. And I'm actually a very big online shopper. I think I probably buy more online than the average bear. But I am anti-bullshit. And there seems to be a lot of BS when it comes to stories and narratives and just general commentary about where e-commerce is going and how it's reshaping the retail industry. Not that it isn't, but it gets blown out of proportion, I believe.
Well, and this culminated in an article that you published in Forbes, and that was kind of driven or spurred by an article in the Wall Street Journal, talked about shoppers, returning to stores. Stores are back. It's this, these not competing but complementary narratives of stores are back as if they went anywhere, and the great acceleration. So how do these two things come together?
Well, the particular thing that the Wall Street Journal article was anchored on was this U.S. Commerce or U.S. Census Bureau data that came out that showed how online sales were dropping quite considerably. And then there was just a lot of commentary about kind of this new appreciation for physical retail. And I think there's a couple things there. One is, and we've talked about this a bunch of times on the show, that yes, there was a very pronounced surge or spike or whatever you want to call it in e-commerce in the early days of the pandemic, which led to, I think that was sort of the foundation for this idea of the great acceleration of e-commerce. I mean, there's acceleration in other things as well, but particularly in e-commerce, where McKinsey had this article that got a lot of coverage that we experienced 3 months of e-commerce growth, 10 years of e-commerce growth in only 3 months. So if you go back 2 years, I think it was pretty obvious that, because that happened in the US anyway, when stores were pretty much closed.
Yep.
And it sort of ignored that, yes, the numerator went up, but the denominator was depressed, and that presumably was not going to last forever. And in fact, it lasted about 3 months. And we very quickly saw that physical retail started growing again. E-commerce was at an elevated level, but you didn't have nearly this massive acceleration. So I think that like first tranche of reset, it was pretty obvious that was going to happen. But then as we got further into COVID, there still was this idea that e-commerce growth has been massively accelerated by the pandemic. And during the height of the pandemic, it certainly was an open question as to which pandemic-specific behaviors were going to persist.
It's going to stick,
right.
Yeah.
That was an open question. I think we have more insight too, not that we are completely beyond COVID, and it's still not that long a period of time, is if you look at the data that the Wall Street Journal shared, pretty much e-commerce penetration, so the sales of online shopping to total retail in the U.S., is pretty much about where you would have expected it to be had the pandemic not occurred. In other words, e-commerce was growing at about a 15% or so annual growth rate. So you could just fit a line to what that curve looked like, the slope of the curve pre-pandemic, and make a guess. And that's kind of where we are right now. On average, slightly ahead of that. But just looking at that data and some other data, it looks like in total we have maybe a year of acceleration, which, in the scheme of things is not that big a deal.
It's my perception that some categories grew more and that the waterline did not recede. And when I speak of that, I think of online grocery, for example, which is kind of puttering along, really, 1.5%. Do you think there would be kind of sector by sector some points of acceleration?
Well, it is the case. I mean, one of the things that I point to in the article and I actually talk about in my book quite a lot is that this idea that the future is not evenly distributed, that in a big diverse industry like retail, there are very different situations depending upon the category. So if you just look at, forgetting even the acceleration question for a second, if you just look at e-commerce penetration by category, you have categories like movies, books, video, which is like 60, 70% online.
Yeah.
And to your point, then you have grocery, which has been single digits for quite a while, and then everywhere in between. And you also have very different growth rates even before COVID. Movies, books, CDs were relatively mature. Apparel was relatively immature. So you see differential growth rates. So it's the averages by themselves are not that helpful. You have to really dig deep into the particular categories. If you look at the data so far, grocery definitely was accelerated off of the trajectory it was on, probably 2 to 3 years. Food delivery also would be considerably higher than average. But that means if you look at all the other categories, to get to the number down in total, they were not, they actually slowed their trajectory. The so what of all this is, number one, getting sort of cutting through the BS part of it is, what are really the facts? What's really happening as opposed to just kind of accepting, just like the retail apocalypse, people sort of accepted that. And there was a lot of it that wasn't true. But the more important thing was, okay, what does that mean for your business and your category? Because if you were Blockbuster, like the retail apocalypse happened to you, absolutely, or Borders, right? Like there are people that got decimated. On the other hand, there are lots of brick and mortar retailers, just like we had Nancy King from Target on the last episode, which, certainly not a retail apocalypse there. I mean, they've actually thrived largely through physical stores. So you have to really pay attention to the so what for your particular situation. But if you're not starting with accurate information to begin with, and you aren't really thinking more carefully or in a more nuanced view as to what it means for your industry, you could very well make a pretty significant mistake.
Yeah, you could over-index your resources or misalign resources because of, where you perceive an overall industry that may or may not be applicable to your category. I mean, it sometimes I think I'm in the twilight zone with some of this stuff because, going back to the beginning of my career in e-commerce, when e-commerce was going to take over retail, everybody just give up. The shopping malls are all going to close. We've been consistently, and I even misspeak by saying we, because I never did, and I don't think you did either. I've been overestimating the importance of e-commerce and perhaps underestimating the strategic, doesn't really matter where they buy kind of impact. Is that your perception as well? I mean, we've been talking about e-commerce taking over everything since the late 90s, but it's pretty persistent that it's not. It's just all shopping. Is that what's tripping people up, do you think?
Well, it's an interesting question. You and I were talking off mic about a conversation I was having with a reporter earlier today, and we were kind of talking about this overall arc, not just specifically what happened during COVID. And so, if you go back to the late 90s, kind of the pets.com era, there were a lot of business models that seemed like they were going to take over the world, raise a lot of venture capital, and pretty much all of them are gone. You had the whole Mark Andreessen software eats retail, all shopping will be done online in the future kind of narrative, which isn't remotely, and I keep saying that's probably going to turn out to be like the worst prediction in the history of business. It's not remotely close to true. You had clearly a massive amount of venture capital investment in the digitally native vertical brands. That premise being that fundamentally you could build a substantial, profitable business as a pure play e-commerce business, so kind of Pets.com 2.0. That is looking not to be the case. And then the whole storyline here about how COVID is going to take us to this whole new water level. Maybe something will happen. Some people are arguing like, well, maybe because it's this post-COVID thing that people are just going to have this kind of short-lived interest in going back to stores, and that won't persist. Or maybe the metaverse will completely change things. And maybe. But if you look at the slope of that line going back 10 or 15 years, it pretty much suggests that we'll be in the vicinity of 20% of all sales online. In 6 or 7 years, we'll be at 30%. And that's kind of the pattern we've seen. Again, different by sector. So I think the reason why maybe people buy into it is there's kind of much more of this logical thinking, kind of an engineering perspective to shopping. Like there's a lack of appreciation. I mean, most of the people that seem to really forward this narrative either have a very strong technology orientation. And so I would say they might be pretty strong on the IQ, but not so strong on the EQ. And so they're not able to appreciate the more emotional, social, connected parts of shopping. And so that makes them underestimate.
Why would you shop? Why wouldn't you just get it? Wouldn't it be more efficient? Just get it delivered to the door. Just like it would be more efficient drinking Soylent than it would actually having a meal in a restaurant.
Exactly. If it's funny, as soon as you started saying that, I was going to be like, just take a pill or
take a pill.
Just because all you're trying to do is get calories, right? Yeah. So I think there's a cognitive bias or something to that way of thinking, but also, and I don't mean to be so cynical about it, there's a little bit of follow the money, right? Like the venture capital firms, they have interest in saying, hey, Allbirds is going to be a $10 billion brand, not just a niche footwear brand that's going to tap out at a few $100 million, right? So, or you're in the technology service business selling technology to power e-commerce. So I think there are a bunch of biases that probably contribute to it. But the learning to me is that, dig deeper into what's really going on. Don't make these broad statements that, on average may be true, but, nobody experiences the average result for the retail industry. You experience your particular view. The other thing I think, which we talked about on a prior episode, and I get into a little bit in a couple of my recent Forbes articles, is there's also a definitional issue of what is e-commerce. So when you see online shopping growth or penetration or whatever, that is where the product is ordered. This kind of zero-sum thinking that as e-commerce grows, that comes to the detriment of physical stores. And the implication of that is you need fewer stores, you shouldn't invest in stores, but that in many cases isn't true.
And that's another long-held thing I've fought in my career, the cannibalization argument. Aren't you just changing dollars? Aren't you just cannibalizing the store? And there's a bunch of responses to that in any business discussion. One is, if we don't do it, someone else will. We have experience with that. And the other is, and you said this often, when you start talking online shopping and in-store shopping, it's increasingly becoming a difference without a distinction, right? And these things, if you think more strategically, which is always what you've said about, we call it an omni-channel strategy, but that's not very helpful. That's not really a strategy in of itself. Just like being data-focused isn't a strategy, right?
I mean, there is this idea, I think that's been held for 20 plus years, both for newer businesses, but also kind of the way a lot of legacy retailers approached e-commerce, was that e-commerce was a business unto itself,
right?
Or a separate and distinct channel. Now, if you're Amazon, for the most part, at least historically, or if you're Wayfair, or if you're eBay or Etsy, like those are businesses that are essentially online only. And so you can think of them more as a separate strategic business unit. But if you're Macy's, if things don't operate in isolation, that people use the store in some cases to do research and then buy online later, or conversely, they research online and then go to the store, either to make the selection or maybe they do online. So there's this symbiotic relationship between physical and digital, which is the case for really the vast majority. I shouldn't say the vast majority because Amazon is so dominant, but when you think about retail overall, the vast majority of revenue is done by brands that have both physical and digital assets. Amazon is really the exception, and then it's a big drop down from Amazon's volume to Wayfair, to eBay and those things, and which are really, eBay and Etsy are they're platforms. They're not a kind of a core retail business. So really,
we've heard this over and over again from a variety of guests. Most recently, as you said, Nancy King from Target, right? 95% of their 20% of e-commerce is done connected to the store, and the number one thing that customers wanted at curbside, in addition to great curbside delivery service, was a coffee, which is just mind-boggling, right? It's just that integration of experiences and retail. And, the other thing that strikes me is on these, when I look at the digitally native vertical brands, which seems to be having a bad moment, is it gets me back to who's running the business and what's their orientation. You talked about, different technology orientations, but in my experience, you need a great operator to run stores. Running stores is not easy. I think of Ron Thurston, for example. When you listen to Ron Thurston, it just oozes excitement for showing up on a Saturday morning and have a team meeting.
Well, I think it's a good point, and I think that'll be interesting, and maybe it's a topic for another episode to kind of get into that more deeply. But I think there was this view, this kind of channel-centric view, and this idea that, going back to what we said earlier, that there was such a thing as sizable, pure-play, online-only brands. And I think, the era of that, again, once you sort of throw out Amazon, it's like
a couple of outliers, sure.
But for everybody else, it doesn't look like there really is much of a pure play online only business of any size. So now, as you get into physical retail, that does absolutely bring a whole new set of skills, and it's still not obvious. And this was the other part of the conversation I was having with this reporter. We're still really, for the most part, pretty early in on really understanding how successful the digitally native vertical brands can be with their physical store strategy. Hardly any of them have more than a handful of stores. And the ones that do, that we know about, is pretty much Warby Parker and Allbirds. And they continue to lose a lot of money. That could change, but it's not as if, wow, that was the thing that has massively accelerated their glide path to profitability. The jury is out on that, but it's certainly the case that running, particularly in Warby's case, they're going to be at a couple hundred stores by the end of the year.
That's a big shift. That's a big fleet, right?
That's a sizable, right? That's a very sizable, complex business, geographically diverse. It's one thing when you're like Glossier and you open a store down the street from your office, right? It's another thing when you're in New York and you've got stores in Kansas City and Tulsa and Portland and Toronto.
And
right?
You're operating in different countries, and
right, going to London and going elsewhere. It's a whole thing.
And it also makes me think about, I don't know how this all fits in, but there's this issue of fundamental economics and disintermediation. This gets back to our Simeon Siegel discussion where they said, well, if you're a brand, just go around the retailer and you'll make tons of money because you won't have to pay them anything, right? The myth of that as well is somewhat connected to this. Well, if everybody's accelerating as a pure play, why don't I just do that? I'll just sell my widget on directly to customers, right? I think they're connected narratives in some way.
Yeah, I think it's just all turned out to be that there's more to it than meets the eye at first blush. That there was this very kind of simplistic approach to how to build these brands. And I don't want to say that building a brand online only is simple, but it's straightforward. It just turns out that there's a lot more to it. And I think you're absolutely right. The next answer for these digitally native vertical brands isn't necessarily all about stores, their own stores, right? It probably, as we're seeing with quite a number of brands, may involve some degree of wholesale, but it's not, there's not just one playbook. And I think there has been a little bit of this, that's the cliche of, when all you have is a hammer, everything looks like a nail. I do think that's probably contributed to some of these companies getting into a fair amount of trouble. Now, whether that was a matter of not, kind of believing their own press releases, or young, comparatively inexperienced founders not realizing the gaps in their knowledge base, or just thinking, this can't be that hard, or whatever. I mean, I've had some personal discussions with some of the founders where I'm like,
economics are different. I get that one a lot. The economics have changed. Unit economics doesn't matter the way it used to. Really? I think it still does.
Yes and no. I mean, I hate to, there's part of me where, aside from just being criticized for being a hype man for brick and mortar, I sometimes get criticized from saying, well, just learn a little bit from history. None of these brands invented D2C. It's been around for a while. Digital, native, I call them now sort of cheekily analog native vertical brands. But there have been companies like Williams Sonoma and Land's End, and blah, blah, blah. Like, this is not a totally new model. And all of those guys have been digital for quite some time. It's not like they just, Land's End had a pretty successful website when I was working with them in 2002. Yeah. So this is not new. So, it's hard to say, like, on the one hand, go back to some things that we know about how shopping works, how retail works, what consumer behavior is like, that may still be relevant today. But a lot has changed. And I do think that the digitally native vertical brands, even if they have discovered, which I think for the most part they have, that the market is not nearly as big as they once thought, that they clearly have to be more than just online only, they do have some advantages of being able to, most of them are much more analytically driven, leveraging customer data. They, generally speaking, don't operate in silos. They never created the silos between online and physical that legacy retailers have been working to undo. They get to pick the best real estate with a lot of fresh new capital. So, in a lot of cases, they're located in better positions than the incumbents they're trying to unseat. They've got, a right-sized store. They've got the latest technology. Everything is built in the cloud from the beginning, as opposed to migrating to. So there are a lot of things that are different and important that you can't go back and say, well, in my day, we didn't need, Snowflake and a bunch of other of this stuff that's maybe turning out to be pretty impactful.
All right, well, let's bring it all home. I mean, how do we frame this? What's your advice to the listeners in terms of, if you're a business and you're trying to sort all this stuff out, you're reading success and failure, acceleration, the waterline increase, the waterline decreases. If you thought about it, and you got an elevator ride up to the top of a hotel in Vegas where you're speaking at a conference and somebody says, what should I do about all this?
Well, there are a few things that I think are pretty consistent across retailers. One is real cliche, of course, but start with the customer. Really understand which customer segments, which purchase occasions you're going after. You're going to need to do some customer journey mapping, because that unlocks, when you part of, I happen to know this about a couple of these digitally native vertical brands. Part of the reason why they started opening stores is they did a lot of customer insight work, and they had a lot of customers that looked like they were valuable prospects say, I'm kind of inclined to try out your brand, but I'm just not going to buy it online. I need to go see it, touch and feel it, whatever immediate gratification. There's a bunch of things. So they were led to some of those early decisions by a deep dive on customer work and the customers they were looking to acquire or grow their share of wallet. So I would start there first of all. I do, to your earlier point, you got to understand whether you call it unit economics or marginal economics or whatever. But as you're growing, what is going to be the set of things you need to do to generate that, that next 10 million, 25 million, whatever it might be, and what are the realistic economics of that? And potentially related to that is the third thing, which is this culture of experimentation. Can you test your way into it? I think one of the problems with many of these digitally native vertical brands is they raise so much money against very lofty prospects that they ended up doing a lot of what I would call moonshots, right? Like, Casper had like 4 stores open where they said, we're going to open 800 stores. And
right.
I'm like, I mean, you may just, I don't know if you're like really plan to do that, but that's just dumb. Like there's no way with 4 stores that have been open, 13 months, you have any idea that you can get to 800 stores. That's just nutty. But I think because of the way they were funded and their market profile, they have to I don't say they have to, but they chose to. But there's an expectation that's been built around these valuations. And so that tends to increase or tends to drive this, just sort of go for it and hope it works out. But now what we're seeing is it's not working out for a bunch of them and they're retrenching.
Yeah. And it just made, my last thought is it takes me back to one of our prior guests, Drew from Indochina, who didn't do what you described. They're growing their stores, but they started with a few and then experimented and then grew a couple per year. Like they kind of measure twice, cut once. So they still have an aggressive growth strategy. But they didn't say, we've got 5 stores. Well, next year we might have 15, which is still aggressive growth, but not that kind of order of magnitude in the hundreds and hundreds and hundreds, right? So they seem to have done that right.
Yeah, and I think what's hard there is, I do think the reality of if you've taken money, like if you think about who your investors are, if you've taken money from venture capitalists that are looking for an exit within 5, 6, 7 years, that pushes you to do some things that perhaps aren't the smartest thing. But, the venture capital model is, if 1 out of 7 turn out to be a home run, that's okay. Yeah, so that causes, I think, some less than optimal behavior in aggregate.
A wide-ranging episode, but I think we drove home the point, and I think we kind of explored it. I'm sure it won't be the only time we talk about this, but for now, why don't we leave it there? If you like what you heard, please follow us on Apple, Spotify, or your favorite podcast platform so you can catch up with all our great interviews and insights, and new episodes will show up each and every week. Be sure to check out our YouTube channel, and last but not least, tell your friends and colleagues in the retail industry all about us.
And I'm Steve Dennis, author of the best-selling book, Remarkable Retail, How to Win and Keep Customers in the Age of Disruption. You can learn more about me, my consulting, and keynote speaking at stephenpdennis.com.
And I'm Michael LeBlanc, producer and co-host of the Conversations of Commerce Next podcast, the voice of retail podcast, keynote speaker, and host of the all-new Last Request Barbecue Cooking Show on YouTube. And you can learn even more about me on LinkedIn or emmyleblanc.co. Have a safe week, everyone.